I just wanted to do a follow-up from this morning's Coffee Talk podcast. It seemed to resonate with some folks pretty well. And I wanted to make some connections. Just a second, let me... Alrighty. All right, so let's get this squared away a little bit. All right, so just some comments from Ken. When I saw you were in here tonight, I wanted to answer or talk to some of the questions you had. So, enjoyed the walkthrough. Me too. The concepts stand well on their own, but learning how to integrate the parts seems to be where the power is. So, life plans and goals, markets, systems, time frames, there's an integration and alignment. So we would call that not only strategic planning, but we also think of that as the next step, operational alignment. And that's, oddly enough, that's the name of the class I'm teaching to my doctoral candidates right now. And so the main idea there is that at the organizational level, the 70s and 80s and the 90s featured the golden age of strategy and strategic planning. And so a lot of folks just adopted kind of a military model and said, if you get the strategic plan right, then you can get your tactical execution will just naturally happen. And so everybody spent a lot of time on how to do the strategic planning and how do you create a vision and how do you communicate that vision to the troops, to the people. And sort of the emphasis was like on this, we're at point A, we want to get to point B. And so everything was invested in trying to come up with all the details of what that desirable future would look like. We imagined that there was some set of conditions that the future was going to hold. Like, we would try to reason from the current situation. What does the current situation have, and what's it like in the future? And if we can imagine those conditions, well, then we can create an organization out here that's really going to thrive. So it was all about trying to anticipate what that future condition might be, and then imagining what our organizational mission would be. We could just say, well, our mission is going to be this. We're going to have these values and that purpose, and we'll have some grand concept. And we put all those things together. What could possibly go wrong? So that's kind of the view from the 1970s to about the 1990s. And a couple things break down in there. And one of them is that in many cases, the tactical troops, the guys on the line where the rubber meets the road, they didn't have any say in what this was going to be. And yet they were going to have to put that into action. And they would say, well, I don't know if you know a lot about the world, but a lot of those things are just not realistic. Or there's a bunch of other things going on in the world over here that prevent this easy, simplified view from taking place. And so there was an acknowledgement that, maybe we are neglecting the people who really have to put that work into action. We got to figure out some way to get them into this process of imagining the future and so forth. So there was a lot of ensuring that the people on your team, everybody involved, that this was like stakeholder analysis. So we got to add stakeholders to this. And the workers. So a stakeholder analysis would also say there's other people that are affected along the way by the way we're going to organize our work. And unless they have input into it, much like the people who are doing the work have input into it, then this thing is going to fail out here because it neglects the stakeholders and the workers. All right, so all we got to do is just get those guys on the team. And if we just get those workers and we bring them into the team and give them some voice in what's going on, well then, we can now have a better way to imagine that future and everything will be fine. Well, then around somewhere in the 90s, the Cotter model of change. I'm trying to remember when that happened. So the Cotter model he observed several hundred transformations in large organizations and said, 70% of those things fail and only about 30% of them succeed. And it wasn't because we didn't have a really good plan. All these guys that were failing had really good plans, and in many cases had incorporated the people and the stakeholders. What were the common failures from that 70%? And then what were the common successful features of organizations that succeeded? Well, one of the things that he came up with, so he identified like seven steps or 7 elements in the Cotter model. And he said, if you follow those principles, then you have a greater chance of success out here in that future. And one of them was that we need to connect this grand vision of strategy to the way we're going to implement tactically. And this is called operations. How you operationalize the strategy and the tactics so that every point on the curve that there's consistency with the way we're changing the strategy is consistent with the way that we are changing our tactics. And so this is called operational alignment. And one of the things that we do is we say, well, we're starting from here and we want to get out there and we want to raise our performance that much, and we're taking these little baby steps. One of the things that we do is this is really a series of little transactions and choices each and every day and week and month. And we've got to see how each of the little tactics are operationally connected to our grand strategy up here, so that each one is moving us in the direction that the strategy wants it. So these are not isolated events. So we think of that as nesting and synergy. So whatever task I'm performing down here, I always want to say, what is the element of strategy that I'm supporting? How does my little piece of the world support the big picture? And so we think of that as alignment. Now, there's a lot of little changes that happen all the way through here. And then somewhere around the early 2000s or so, enough people were still failing with the Cotter model, and there was a recognition that there are some cultural elements involved. And so if we took a look at some kind of triangle, we looked at the visible portion of this iceberg, and people were focusing on the direct tasks, explicit instructions, rules, policies, and things like that. But underneath that, at the hidden layer, or almost the unconscious layer, the difference between what we say and what we actually do, that there's all of these little elements in here, these cultural elements. Then when there's a disconnect between what we say and then how we actually do it, culture is the sum of all the things that we do and why we do them and how we do them. And that takes on a real power in the organization in terms of its identity. You can actually say that the culture is the lived values. So if the organization or the person has values, and we might have goals that we state and things we want to represent, but the things that we do actually reinforce the values we actually have. And so this lived culture. So it's not just the organizational structures and the policies and procedures, but the way we kind of behave each day in every way. And so you want to be aligned with your identity, which has deep roots into who you are, and your long-term kind of unchanging values that I talked about. And then that allows you to choose certain goals in the world. And then we want these systems that allow us to translate this strategic identity into specific measurable goals. And this is that operational connection between who we are and what we want. And this is how we do it. So this might be ends, and the systems might be the ways, and the goals are kind of the results. And then the means are the means would be, the resources that empower these systems. So when I talk about integrating, in some ways it's putting on a different hat, but in other ways it's really hats within your wardrobe or a different lens. It's still the same kind of, it's still you. But you might be adopting a particular lens to see the world, but it's all part of who you are in your operational space. And so you put on this lens to look at that thing. And so you have a number of lenses that you put on. So in the same way that you have systems, you might have points of view and perspectives, so that when you're trying to perform a certain task, you choose the lens that you want and realize that that lens gives you the power to magnify some things and shield some other things, and gives you the ability to focus on the particular thing that you're looking at. But every bit of focus means that there's some other possible blind spots. So if this is me observing and I'm trying to look at this range of phenomenon, and I put on a lens that allows me to really focus hard in here, then I have to be concerned about what I'm missing. So by having multiple lenses and multiple points of view, as I described in a research orientation video I sent out, you start being able to get a more comprehensive look at the world at the boundary of your perception. So integrating those different streams of information. So now I got all this information coming to me from the world, from all these different lenses. And now I got to be able to catch them all and then make sense out of it in an integrated way. That's kind of what you're asking about. So really, before I answer some of your specific ones, I just want to highlight again. So that the strategic planning, that vision of the end state and everything, that's fine. And that's going to act like a big magnet to pull you forward because of what it represents. But all this connecting tissue, who you are and how you do it today tomorrow, the next day, and this plan to improve your path as you go along. This is where that idea of culture and feedback and learning and the principles, I would say, that work for me, those principles of the Shingo model that sees that strong connection between culture, systems, tools, actions, all act to reinforce, so that the way we do all of these little things are contributing to an improvement of our overall operational concept, which allows us to achieve our strategic views. All right. Sorry, wrong one. Crap. Although it may seem like it, I'm not drunk. It's just it's not cooperating here. All right, let's back on board here. All right, so let's get to the specific, a scenario example. All right, so I have a swing position on and also day trading in the same symbol in the same account. And when I exit the day trade, I feel like it should also exit the swing position too, since the day trade might be starting to take a loss. And I don't want the swing to be at a loss too, even though theoretically I know they both have different stops. Right? Yeah. So that's one of that core and turbo feature, is that if I started off with a 5-day down pattern, I have reasons now to believe it could get back up into here. And so I frame that trade, and then it starts taking off. And now I have reasons to believe that this thing will get here. But I also know that on the initial entry, that a stop below that initial, low of the day, the previous day, that any price action that comes down in here invalidates. That's going to invalidate that trade hypothesis. So we can now think of this, the space in here, as the yellow zone. Like any price action in here doesn't give us any new information. That thing is still full of potential until it either gets up here to our reasonable target, or until it comes down here below our stop and kicks us out. So we don't have any new information on the swing time frame until that happens. Now, as this thing starts going up on the swing trade, our exit strategy now reflects our sense that, that thing moved up enough, and now I'm going to lock in my gains. So now I've locked in these gains here. That's like that no lose plus dinner for two. And now what I've said is the fact that I have money in there and it's locked in means this thing is no longer just potential. It had some actual gains. And that I'm willing now to treat this price level in here as the noise, the place where I'm willing to give it room to run. You know, price is 0 now, I've locked this in. So now the space between the blue and the red, conceptually, I have to think of that as this is now the noise area, just like that was the noise area. Let me change that color there. So this is just noise in here on that time frame. I don't have information to take action on it yet. So if that's what my swing trade looks like, and now if I decided for certain reasons that thing is starting to work, and now I can go into here on the day trade. And now when I look at that thing, and this was my swing trade, and maybe that's a $1 stop. And it opened here and went up through that. So now I have my swing trade pattern on, and I have this noise level down in here. And so maybe with $400 at risk and $1 at risk, I can have 400 shares. But because of reasons, you know, I have maybe there's my 10-day high up here, which is where I think that thing can get to. But maybe the next target level on the intraday, might be right up in here, right? So maybe there was we're just going to call it, the hump of the dragon had rolled over here, and we would say, well, on the basis that was the statistical reversal point, I'm really concerned that on that price action around here may feature, it may just do what it did before and start to roll over. And maybe that's $1 away from my entry. Maybe it's $1 to there. So maybe I can look at the MMRB. When I do my MMRB, that thing may be 20 cents. So if I have $400 and I'm risking 20 cents, now I can have 2,000 shares and still only risk the same amount that I have on the swing. Because of that wider stop, and because of the way this swing trade is framed, I'm willing to take that risk with $400, which means 400 shares. But on the intraday trade, if this thing starts moving in my direction, I've got a really tight stop in here of 20 cents. Now suddenly, that's the amount of risk that I'm willing to take. And now if this thing moves up, 20 cents or 30 cents in my direction, well, and starts to hesitate, I'm saying, you know what? It's already moved up enough. I can lock in no lose plus dinner for 2 here, because inside this context, I have enough information that says it was a good enough move to take away the noise, to move it out of the noise, and to give me some actual gains. I have actual gains in hand. And that's a different relationship than this one over here, where the noise range is wider. Plus, I got 2,000 shares on it. And so if I just treat it all with all in or all out, that means I got to tolerate $1 loss. No, that means I'm going to lose $2,000 if this thing moves all the way back. So I can't do that. So if you want to manage that trade so that when you put an extra intraday trade on, plus your swing trade, if you want to be all out of it, then this position can only be $400 because you're really risking $1. Or if you're going to use the tighter stop of the turbo trade to be all out, well, then you just got to recognize that I'm not going to make as much money. I'm really overriding the original trade frame here. And what I've really done is converted the 400 shares at risk from the swing trade, and I've just added that to a $2,400 or 2,400 share position, and then I can be all out. Now, is that wrong? No, that's not wrong. But what you're going to get is, you might make 20 or 30 cents in here on 400. But then in the swing time frame, these little oscillations that occur inside here, I mean, it could be looking like this all the way up. The swing trade buffer is designed to be wide enough that you can tolerate a lot of messing around inside here, as long as that thing is still not hitting your swing trade exit. Then you don't have any information that says these future moves have started to weaken. Only when this thing rolls over far enough and it hits your trailing stop can you say, oh, that's the point where it stopped. So you can afford a wider stop according to the analysis from the day charts, because you're operating on a longer time frame. So you've either got to keep those two things separate in your mind. The swing trade is this and the day trade is that. And just, you got to train yourself to say, the stop for this thing is appropriate for the swing, because I'm really looking for, 3, 5, 10 days worth of movement to get it up to the 10-day high. And I have to treat that as an independent trade. But since I'm already interested in this thing and I've seen I've done my price ladder all the way up, I may realize that there are certain moments on this step ladder approach that it makes sense to get an extra day trade and a day trade and a day trade, and that all of these are an extra payoff for doing the work for analyzing the swing trade. If you decide to get all out, though, just recognize that there's it's a 50-50 chance probably that this thing rolls over and then starts to go back up. And now you got to come back and say, well, am I going to reinstitute the swing trade? Because I should, because it's still within this noise channel. It never took out my original stop. And then you may feel anxious. Well, then I should never have gotten out of that to begin with. That's one way to look at it. But as long as you're doing core and turbo trading, you're going to face that all the time. Now, I like your idea of saying, hey, I've got a swing account over here, and that thing is just going to perform according to standards, and all that does, and rules, and all I'm going to do is use the information for that for the day trade account that's over here. And now the beauty of that thing is you can be long or short in this one. So when this thing is going up and working and the day trade is good, you've got extra juice going on the way up. But if it starts failing on the intraday, you can actually be short in the second account, and just enough to make this market neutral. And now you're not losing any money on your swing trade because it's hedged by the short position in the other account. And then when this day trade reversal starts moving back up and you flip from short back to long, now you're going to get double goodness on the move, because you're getting the swing benefit and the day benefit. So having two separate accounts is a good idea. It actually lets you keep the swing trade in a long-term taxable account. And if your day trading is in a non-taxable account, like a futures account or a corporate account where you're doing mark-to-market, or a retirement account, then you're going to get the benefit of the favorable tax treatment there as well. So I think that idea, keeping them in the separate accounts, is a good idea. Let me know if that was enough or you needed more on that. So now on the next idea on risk, yeah, risking 100 shares on the day trade and then 1% of 100 grand, so $1,000 on the swing trade. And then 10% of an account on a core position. And let's say that's a retirement account, and let's call that maybe 250K. And so you're risking 10% trailing stop on that one. And maybe that is, so the 10%, so it'll be a $25,000 open risk on the core. Now having these in 3 separate accounts really does matter, because now what I want, so now you have a day trade, a swing trade, and a core position. I like a 40-40-20 split in my money, so that these wider 10% stops is on half the size of the account of the swing trade. And because the day trade, there's 5 days of tactical trading at the smaller levels of risk, but more frequency, and that's going to equal 1 swing trade, time frame, if you will, like every 5 days with wider stops. So this might be $100, but it might be a 20-cent risk, and this might be $1,000, and that might be a $2 risk. So it turns out, the position sizes are different. So the amount of actual money at risk, it's $100, but now you can scale that. It's 100, then it's second, third, fourth position or more, and then all out. So you're generating money here that can reinforce the swing or protect the swing as a hedge. And then, so this might actually, the 100 versus at 1,000 is like a 10-to-1 difference. I kind of like about a 5-to-1 difference, because then I can, when I keep 20% of a successful day trade, that equals like 1 swing position at a 5 times wider position. So if I had a 20-cent risk on the day trade, and so I had 2,000 shares in our example, and then I just say, that thing is really working well, and I want to use that to fund my swing trade, I can just bump this from 20 cents to $1, and then 2,000 shares get scaled down to 400 shares. And now my risk is identical, but I earned that $400 of risk with the gains that I made on the 2,000 shares. So I'm already more relaxed on how I risk that swing trade. Well, the swing trade can work the same way for the core. And believe you me, that I am using the swing trades as a way to hedge against the core positions. Because if my intention is to hold that for a month and rebalance, then in 1 month that core could experience a significant risk. So if I found my swing stop was there, I may very well be short in the swing enough to make the core position market neutral, so that I can still keep that long-term play. And if you look at that PBW position, that's an 8-month position that has returned 140%. But there were moments in there where where the indication on the weekly charts was to exit a swing position. Well, when I see that on a weekly chart, that tells me I need to put a hedge in until it gets through that troubled waters. So it's almost like, as this thing is going up, everything's okay. It gets to a critical state and starts to wobble. Until it gets out of this critical state, I initiate the hedge and protect it. And then when this thing starts resuming, I can put the swing on, and now it's getting double good. And when it gets above that critical state, I can just relax and let the core position go. And if you look at PBW as the example, now that same relationship we have between day and swing is the same relationship we have between swing and core. So what you got to find is the harmonized ratios of risk in here. I kind of like 40-40-20 as the overall asset allocation, and that really makes me primarily a swing trader. I just think that the rate of change is, in the 1900s and 1800s, those long moves in commodities or railroads or whatever it was lasted decades or years or even months. And so you got these long moves like this. But now it just seems to me like the opportunities to make that money is a lot faster, but the swings are bigger and more compressed. And so I don't think those old school rules that just leave it alone and come back in a year and look at it again make sense in a world in which digital connectivity and tightly integrated markets and leveraged robo-trading. I don't think the heuristics of 150 years ago, why would I believe that they should continue to work in a market where the participants are using extremely different rule sets and different platforms, and the currencies are tightly connected, and all of the slack is out of the system, so you don't have these long-term, slow-moving, changing positions. We're talking about incredibly volatile systems where the truth changes fast. Yeah, Luis, I'm gonna look at PBW here in a minute. So what I want to say in general then is the nature of risk here. I would say the 10% stop, that may be something that you want to adjust. You probably want to look at the ratio of money between the different buckets of money and decide how you want to harmonize those. If the core position is bigger, then I think you got to use the swing trades more carefully to hedge against that. And you get to adjust and adapt and respond to changing risk profiles quicker on the day trades and swing trades, and that allows you to take longer times between decision making on the core. So I've sort of settled on this 20-40-40 ratio in here, and that seems to be about right. And then I like the about 5-to-1 in terms of position size and how tight my risk gets. So when the day trades really work well, I like to keep 1/5 of it for a swing trade. Strategies on how to rebalance money or percentages between what criteria should that really comes between risk and how relaxed and confident can you be so that you can actually execute your rules. So if you put together a rule set, but then you find yourself in practice still experiencing some of these notions, then that tells me, that would give you evidence that you haven't satisfied your risk brain yet, or you just need some more practice with it, I would say. But I would try that 40-40-20 and then the 5-to-1 ratios. And then you may need to adjust the 10% stop to a 5% stop to account for the risk without increasing the position size. Yeah, and now juggling time between the various time frames, research, and psychology work. I have each day, I probably have 3 windows of time. That opening 90 minutes, I like trading the lunch period because I can get 1 or 2 positions and really engineer the stops tightly when the market gets quieter. And so I concentrate on 1 or 2 things that really worked in that first segment. And then I try to exploit the quietness and then catch them as they're coming out for that afternoon moment. Well, when I'm only watching 1 or 2 things and it's pretty quiet, I can budget my time in little 10 and 15-minute increments I can get a lot of work done actually in 15 minutes, whether it's doing a spreadsheet, doing some analysis, doing a sketch and a reflection, or studying some psychological elements. So I just have the use of like the flashcards for me is I like to read intensively for 10 to 30 minutes and produce 1 or 2 flashcards in a chunk. And then that burst locks it in. Then I have to go do some other things. And so maybe shift the target. So I do up to 30 minutes of work, 30 minutes of work, 30 minutes of work, maybe shifting the object. So I might be reading one book or one study here on psychology. This might be one on trading. That one might be on strategy making or military logistics or something. So I find for me a 30-minute burst, then I need a break. And then sometimes I'll string together 4 of those into a 2-hour burst for a deep dive session, and really go deep on a specific project. And then after 2 hours, I really got to take a break. So that's kind of like the Pomodoro technique, Pomodoro. Pomodoro is the little tomato. That's the guy that starts with training your attention in 6 or 7 minute chunks. Focus on one thing, really work it hard. Listen to the bell ring, then take a 1 minute break, then shift another one. And don't do anything else in that 7 minutes except that thing that you're working on. And then you string 3 of those little 7 minute chunks together, and now you have a 20 minute, or 4 of those minutes, you got 28 minutes, and that's a 30 minute, right? So that's how you start building up these little work segments, and then build your time calendar just like that, and reward yourself for successful accomplishment of that mission. And that means you got to turn off the radio, or maybe it's just white noise, but maybe it's listening to flow music. But turn off the phone, turn off the internet, shut off the email, have the alerts on your charts. And I can kind of monitor that as I'm working these chunks with that screen. I can feel that and check in. So I've got 40 years of experience of doing that, managing Army command post operations, where you have a big battle board, and then there's one particular thing you're working on. And so part of me, you can have 10% of your attention kind of attuned to one little alert that tells you that something's going on. So that's, you can train your attention to do a background work and then a focused work. As long as that background work's not intruding, and it has clear alerts on there to tell you when it's time to pay attention and quickly dial in. And that's sort of the advantage of I would say, the fractal approach to the patterns. So for me, when I'm looking at that chart, it's always the same array of indicators and chart presentation and the number of bars on the chart and all that, and all the key price levels noted. So once I get used to looking at that chart in a certain way, in a second, I can dial in and see what's going on based on time of day and trade location and all that. So you got to be able to carve out those little work times to do the deeper work, instead of just kind of staring at the screen waiting for the 5-minute bar to fill. That's 4.5 minutes where you can get some work done. So I can grade a 3-page paper in 3 minutes. I can read an article in 5 minutes. I can make a sketch for a whiteboard or something in 5 minutes. So I can make use of that, of those little slivers of time. And I just have a lot of projects that are always ready to go, and I can shift between them quickly. So it's just part of training your attention span, and that's where the dashboarding and your operating process needs to be mapped out and modeled, so you always know where you are in your cognitive space. So that's what I would propose to say about that, okay? Let me know if you need to hear more on that, Ken. I mean, I've got that that operational brain of mine trained to the point where in combat, when I was running a command post, I could sleep at the radio station with the headphones on in a relaxed position, monitoring 3 different command nets, one at the division, one at the brigade, one at the battalion level, and listening to 3 streams of conversation and catch like a little cat nap and instantly kind of spring awake when something was said that got my attention. And so it was like I was in a deep state of relaxation and very restful, very near sleep, but just enough idling on there, being able to listen to things and pick out the things that mattered. I wouldn't advise that as a way to develop that skill, but that's kind of what it's like. Yeah, I'll just use the PBW example of the weekly chart. If this will. So even the weekly chart on PBW is actually doesn't actually have that many decision points on it. All right, so this was February 2000, March. This was that peak. So we were already in PBW here because it was outperforming all the way up the stack. And here was a Z3. It rolled back. It found support at the edge of the dragon and reversed. So when it took out this little doji on a weekly basis, that's another position. Or if this got you out, it shouldn't, but if it did, this should get you back in. But this is an opportunity to get another position at about 38. And then this move here gets you to 45. So that's plus 7. That's a 2% gain. Oh no, 20% gain. $7 on 38 is like 1/5. So that's like a 20% gain. So just that move from here to here is a 20% gain. So when we're looking at the standard chart patterns, hey, here's a Z3 excursion and then rolls back underneath here. You can take that exit right there and harvest this excess position. So I might have one position on here because of the core and that thing's working. And now on a weekly chart, here's a reason to get a plus swing position on and trade that from 38 to 45, and then it rolls over and maybe you exit at 43, give it $2. So that's plus $5 on 38. That's like 1 out of 8. That's a plus 12% gain. Guess what that 12% gain pays for? The 10% trailing stop that you were using on the first position. So you just, this extra position that you got from the turbo pays for the risk that you're currently holding in the game. Okay, do you see that, Luis? So all I'm using is swing trading technique with the RLCO framework, and that's kata number 2. Oh, and now this one, let's take a look at all this. So when we see this, when we see this little signal on the weekly, that's a sell signal on this excess gain that you made of plus 20% in 3 weeks. Now we have the RL10 peak rolled over, and you could legitimately, and it crosses the baby dragon, and it comes back from Z3 into Z2. You would be justified here in cashing the original core position, because now this is off at 45. And I can't read what that price is. Just a second. $40. Hey, so it got to 45, and this is at 40. Your 10% stop got you out here. Look how far above the Bollinger Band mean it got here. So it could get that far. It did. Look at the RL10 compared to the RL270. Here's the RL270. That's the fair value. This thing, all it did was come back to the fair value. This difference between the fair value and the peak RL10, that's the RLFF lens of analysis. The difference between the RL10 stretch and the RL270 long-term fair value, you take a look at that and you say, oh, that's how far the traders were able to stretch it away from fair value. So when this thing rolls over, you're not allowed to be surprised if it comes back to fair value through that lens. And that's exactly what it did. And that's a move from probably 40. Let's see if we can find out what that price is. That's a move from 40 to 30. How could you have gotten into that? Well, here's the PSAR flip. This is this little red dot here that I just drew a screen. That move right there is kata number 2. That's the supported fall crossing to the downside. Look at this. Summer just turned to fall. And if you don't get short here, you should get short here when it crosses the Bollinger Band mean, because when the Bollinger Band mean is stopped, that means all of this stuff is negated, and now the move is down. Where could it go to? To Z1, Z2, and Z3. And it just crossed the RL270. So now, on a weekly basis, this thing came all the way down to Z3. Oh, look what it did here. Here's a 1, 2. Now, this didn't break out a new high, but here's a 1, 2, 3 entry, and it had this excursion below the RL270, and now it came back to the RL270. Fall became winter. You might wait for the baby dragon to get crossed. You might wait for the winter to become spring. So you might get this entry here. And with the Wu Wei exit, your swing position is this. So here's where it equals my entry. 1, 2, 3. Here's the Wu-Wei exit, and now you could pick up this or pick up the Bollinger Band mean and go. On a weekly basis, I'm not offended if you just, even if you picked the belly of the dragon and just use the belly of the dragon. On a weekly chart, that makes a lot of sense. On a daily chart, because the volatility is greater on a percentage basis, you might want to do the Wu-Wei. But on a weekly basis, if I get this, I put a stop here, and I just use the bottom of the dragon. And you're still in the trade up here. You're still in the trade. And that's an entry at 33 with a 10% risk. And this thing's at 75. That's plus 42 on a $3 risk. 14R. That's just using a weekly chart, a weekly adjustment, weekly charts. So if I'm looking at this combination of day trading, swing trading, and core, somewhere around in here, this thing moved back to the top of the core blended monthly rebalancing. And so it bought it in here with a 10% stop, and that's what this one looks like. But you could, on the basis of these charts, you could add that little weekly turbo, so you have the core plus a turbo, and then if it looks like this thing is rolling over, I could just cash the turbo, and then the extra money that I made in here pays for the core risk multiple times over. And then when it doesn't fail through the dragon, and I re-enter here with Cotter 2, I make another chunk by entering at 60, and I'm still not out of the position, and my stop is $10, so that's another 1.5 R. So you can use core and turbo with swing trading and the core positions by just looking at the weekly charts. You know how many weekly charts you can look at in an hour? 50. And that's a full minute. And when you're setting these up and it's just one more bar, it doesn't take you a full minute to make a decision. You should be able to make that decision in 5 seconds. And if you go through if you've been following along in the daily podcast, when we do this, look at all the speed runs. I'm spending 5 to 10 seconds maximum on 50 charts a piece. So that's 10 seconds times 50 charts is 500 seconds. That's 8 minutes. So in 10 minutes, with end-of-day data, once a week, you can evaluate 50 members of your herd. So spend 10 minutes a weekend and look at 50 charts and see which ones are setting up in critical states with all our fractal patterns, the Cotter 1 and 2, and the OWL, and the minimum manageable risk box. And the core systems, the BMR, is already telling you what the prime targets are. That's why I do that on the weekend, so you can listen to that video and listen to the signals that I'm calling off and the targets that sound interesting. Like tech is back in business, and so is clean energy, and so is Tesla, and so is Twitter, and so is materials, and so are the industrials. Oh, XLB. Here was that sell-off. It's well above, and it's now well above this little chunk. That's free and clear. Off it goes. So if that gets above this price level, above 68, bam, off we go. How long did it take? That took 7 seconds to make that decision. Now, I picked that one because I remember what I said on the weekend report. Procter & Gamble, ready to make its breakout. It sold off and now resumed. So there's the next breakout. And if it gets above 145, then it's going to look like one of these, one of those great big moves. But in this cluster down here, here was the peak of the, you may recall that I covered this one sometime earlier this week. Here was the bottoming of the RL10. Here was the top of the RL10 when it rolled over. Here's how far it rolled back, and then it resumed, and winter had already turned to spring, and there's your RLXD, and there's your spring entry, supported spring crossing. So that lets you get long at 117 with a stop at 110, so that's a $7 risk, and that thing's at 145 right now. So that's $35 gain on a $7 risk. That's a 5R win on Procter & Gamble that pays a dividend. And it was the strongest, it was by far the strongest stock in the Dow this entire period. All the way through here, it was the strongest member of the Dow. It sold off and now it's getting ready to go again. Do you think I want to own Procter & Gamble as we try to come out of the COVID virus and they're going to spend another $2 trillion helping businesses? You bet I am. Procter & Gamble. So that's how you start using the weekly charts to build out your longer-term portfolios. Weekly charts, standard framing, find the patterns. They're all fractal. Now, if I'm trading XLB, that's why I trade XLB and those metal companies on the intraday basis, because when you see a great big old move like that on a weekly bar, guess what that looks like intraday? Oh, it looks like, look at the size of those moves. It moved from 142 to 144. That's 1.5%. And the size of your risk is 20 cents. That's a 7R move from in here. There's your supported spring crossing. Here's the second position when it breaks across the VWAP and takes out the previous hump of the dragon. So there's two positions, and that's the first one is 5R. This one is probably 3 more R, and there, it never even looked back. That's the lowest risk trade that I know. Cotter 2. And that's, and guess what was available? If you had Cotter 2 over here, and you have a collapsing dragon here, and you can make money from 143.5 down to 142.5, and then turn around and make it from here to here, hits VWAP and bounces like it should, supported spring crossing, and back all the way to stop where it did last time. When it got up to here and collapsed and came all the way back, and now it got all the way up to here, that's the same price level as it was here. And what did it do here? It collapsed. That is the least surprising behavior of all. Lather, rinse, repeat. Which is why when you see this thing fail here and pull back and now it starts to resume at a higher low, when this thing doesn't fail, but instead breaks out higher and crosses the VWAP, the last time it crossed the VWAP, it went from here to here. This time it went from here, to there. That's what when it gets a buying frenzy, that's what it does. Read the chart. That's how that works. Okay, that's everything I want to cover tonight. That's turned into almost a 2. Well, it's a good hour. That's what I wanted to say. Okay, So I'll get that published as a supplement here shortly. All right, we'll see you guys tomorrow. Let me finish by asking, any other questions? Did that answer your question, Louise? Ken, are you good to go? Okay, good. All right, that's all I got, guys. Time to walk those doggies.